George of the jungle, strong as he can be.
Where can I get money to come up with a down payment to close my loan? That's what we're going to be discussing today in the creditjungle.com. My name is George Anderson, and thank you for coming in. And you know, we keep talking about this. We're in this very, very competitive market right now, pretty much anywhere in the Intermountain West, but particularly in Utah right now. And sometimes people have to come up with a little bit more money to be able to make a stronger offer. Maybe they need a larger earnest money. They need to show that they're getting a conventional loan, maybe with 20% down. They've got to do everything that they can to try to make their offer look better, and they start scratching their heads and like, well, I don't know, where can I get my money from? So we're going to discuss a few things today, and I've got a couple of things written up here on the board. I've got 401k, I've got vehicle, I've got insurance policy, and I've got another property. What do all these things have in common? What they have in common is that these are collateralized loans. These are collateral. In other words, that there's an underlying asset and you are borrowing money against that underlying asset. Now, in addition to 401k, you could pledge an IRA. There's other things like if you have stocks or something like that. Anything that you would do that would be collateralized against this type of a security instrument on here this is okay to be able to borrow this money. The other thing that's specifically pretty cool about a 401k is that if this is running through like your employer and you have a plan administrator, all these different plans, they have different stipulations. Some you can only have one loan at a time, you can only take it out for these reasons, there's only a certain percentage of the money that you can take out. Every plan administrator has some different things on it, but Fannie Mae, Freddie Mac, FHA, and VA all recognize that you are borrowing money from yourself. And so I've got this other column up here called DTI, or debt to income ratios, on here. If you are borrowing money from yourself on a 401k plan, if that payment ends up being $300 a month or $400 a month, does it necessarily blow out your debt ratios? Well, the answer is no, because you're borrowing from yourself. Okay? So you're borrowing money from your 401k. It doesn't matter what that payment is. It does not become a factor in your debt to income ratios. Now, why not? What's the consequence? What if you don't pay the loan back? Well, if you don't pay the loan back, okay, they're just going to make a distribution. They're instead of changing it from a loan, they're going to change it to a distribution. You don't have to pay it back, but you're going to end up having to pay taxes on that and whatever the penalties and everything else is associated with that. Sometimes people may have a vehicle, or they may have, maybe heavy equipment, something like that. They've got something that has a title to it, that they can demonstrate that I own the vehicle and that here is a reasonable statement of value. Okay, in other words, off of, you're not going to be able to finance, $20,000 vehicle loan against, a 1998 Geo Metro. It's not the value, because the value is not there. So you need to establish, like through Kelley Blue Book or NADA, what the value of that vehicle would be if you're going to get a loan against it, or just the paperwork from the bank. If you went in there to your bank or credit union and said, hey, I need a loan against the title of my car, you can use that money for a source of down payment, because we know where the money's coming from. We know that you own the asset. But here on the debt to income ratios, if that payment's going to be a couple $100 a month or whatever it is, then yeah, we do need to count that into the debt to income ratios. Another option here is an insurance policy. There's lots of insurance policies out there that have a cash value, and they accumulate as you're paying your premiums over years, and the cash value of that policy grows. They have loan provisions within that insurance policy where you can borrow the money against it. And sometimes it may have just maybe even an annual payment or just a suggestion that you make a payment. But a policy loan against an insurance policy, again, it's collateralized, because we can see here's a statement that shows that you own the policy, you're the owner, the value on there, we can see the value in a statement, and whatever they agree to loan you, then that money can also be counted towards the down payment on a home. And again, no, because you're borrowing against yourself, against an asset that's very easily collateralized. Here's collateral too here, but selling the car might be different here than just liquidating a 401k or liquidating the insurance policy. So again, no, do not have to count the payments here, borrowing money from your insurance policy. Now, this one here, I've got an asterisk by this one, and I'm going to just finish up with the asterisk. But the other explanation on here is, what if you own a piece of land? What if you want to borrow money against the house that you live in right now? Or you have a rental property and you want to borrow money against that? Yes, you can go out there and you can get a first mortgage or second mortgage, whatever you can qualify for, and you can use the equity in that property as collateral to be able to get a loan. And then that is also another way to get additional down payment money for a loan on a house that you want to buy. But we do have to count again, because here we're trying to liquidate an asset. These are already liquid. These are already liquid here. That's why we don't count the payment against them. These are not liquid. So the vehicle and the other property, again, we're going to count that payment into the debt to income ratios. So back to here on this asterisk here, if somebody lends you money, let's just say you don't have enough time. I mean, maybe you're buying an investment property and you can't use gift funds to be able to purchase an investment property. So you need to be able to show that it's your money, but you don't have your money, and all of these options just don't exist. But you have your own home or you have another home and you need to be able to get this money quickly. Could a family member be the lender on another property that you own? In other words, if you're buying investment property, your dad can't gift you any of that money towards the down payment. Okay, so whether it's 10 grand or 50 grand, dad probably has the money. He's more than willing to help you get into the investment property, but he cannot be a gift donor on investment property. If it was primary residence, absolutely, sure he can. But this one's not. This is investment property. Could dad be the bank? The answer is yes, he could. So you'd have to record a trust deed and a note. And what the Fannie Mae guidelines say is that there has to be a reasonable interest rate on it. So, I mean, you can't put it at 0% interest. You know, what's the floor of that? I don't know. I just know it can't be zero. Dad's probably not going to charge you 17% interest on it. And the thing of it is that it actually can be an interest-only payment as long as there is not a due date or basically a balloon within the first 5 years. So it could be a 5-year amortizing loan. It could be, I mean, if it's an amortizing loan, it could be any term you want. But if it's an interest-only loan, there can't be a balloon payment within the first 5 years. So you do a 5-year note on that. But you can structure this, even though you can't get a gift from dad, you could let dad be the bank. And again, this is another source of funds to be able to get more money to make your offer look stronger with either more earnest money or more down payment. And in a competitive market like this today, it's important to understand what different areas that you might have collateral that you can access those funds and be able to put in an offer and make your offer a little bit more attractive than the other buyers you're competing with. So hopefully that helps you. Thanks for coming into thecreditjungle.com today. This is George Anderson. You can push button, get mortgage professional, and I'd love to help you figure out how to make your offer and your loan the best terms possible for you. Have a great day.